Welcome back to FinFlow Media. Day 12 of our 100-Day Wealth Challenge is officially here. And man, am I thrilled to jump into this one. If you've been rocking with us, you know we've been systematically breaking down the nuts and bolts of building net worth. So today, we've got a very special explainer lined up. We're tackling what is literally the heavyweight championship of the financial world: real estate versus the stock market. Where exactly should you be putting your hard-earned cash? We're going to look at the hard facts, the real numbers, and the ground realities of both of these wealth-building giants.
Okay, let's dive into this. When we talk about building generational, long-term wealth, these two asset classes absolutely dominate the conversation, right? You've got one camp fiercely defending bricks and mortar, and the other side entirely committed to the markets. But the burning question for us, the everyday wealth builders, is which one is actually superior? To really nail that down, we've got to understand the underlying mechanics that make each of them so incredibly powerful. So here's the fundamental dividing line between the two camps. Real estate folks, they will constantly point to the tangible nature of their assets. They absolutely love physical ownership and, of course, that steady stream of monthly rental income. But on the other side of the aisle, the stock market crew champions the power of compounding index funds and, this is absolutely crucial, instant liquidity. It's a total clash of core philosophies, Tangible, cash-flowing assets versus frictionless compound growth. Everyday wealth builders are constantly debating between these two paths, and honestly, it's because they both offer incredibly proven routes to financial freedom.
Let's kick off our analysis with contender number 1, real estate. Now, obviously, beyond the fact that you can literally touch and feel a house, the absolute primary mechanical advantage of real estate is leverage. Leverage is the financial engine here. It's the ability to control a massive asset using just a fraction of your own money. So let's actually break down the exact math on how this explodes your net worth.
All right, let's look at the numbers, because this is where the mechanical magic of real estate truly happens. As you probably already know, if you want $500,000 worth of shares in the stock market, well, you need $500,000 in cash. But in real estate, it's a whole different ballgame. You can secure that exact same $500,000 asset using just a 20% down payment. That's $100,000 of your own money. The bank swoops in and finances the rest, the remaining $400,000. You're essentially using the bank's money to control a massive appreciating asset. So, what happens next? Well, let's say the local housing market has a very modest, totally average year. The property value goes up by, say, just 5%. Because you own the entire asset, that 5% growth is calculated on the full $500,000 value of the home, not just your down payment. A 5% bump on a $500,000 property yields a very real $25,000 gain in your net worth. And this brilliantly illustrates the true power of leverage. Think about it. That $25,000 gain we just talked about, when you measure that against the actual cash you put into the deal, your $100,000 down payment, you just scored a massive 25% return on your initial capital. The property itself only grew by 5%, but your wealth, it grew by 25% simply because the bank took on most of the funding. This mechanical multiplier effect is exactly why so many hardcore investors absolutely swear by real estate. And get this, the benefits don't even stop at leverage. On top of that incredible multiplier effect, if you're renting the property out, it's generating monthly rental income for you. Plus, the government actually incentivizes you to own property by offering some pretty significant tax benefits, primarily through depreciation. You're basically getting rewarded by the tax code just for holding onto the asset. It's kind of wild.
But hey, we have to keep our feet on the ground here. It's definitely not all sunshine and passive income. There are some heavy, sobering realities to being a landlord. First off, the entry barriers are steep. Scraping together a $100,000 down payment, that's no small feat. Then you're getting hit with ongoing property taxes and those inevitable, annoying maintenance costs. Plus, dealing with tenants can be a massive headache. Trust me, nobody wants a phone call about a flooded kitchen on Thanksgiving morning. And perhaps the biggest kicker, real estate has practically zero liquidity. If a sudden emergency hits and you need cash right now, you can't just sell off the guest bathroom overnight, right? Your money is literally locked inside those walls.
Which brings us sharply to our second contender, and the contrast here couldn't be more stark. We just established that real estate means zero liquidity and high maintenance, while the stock market is the exact opposite. We're talking absolute liquidity and zero maintenance. This totally effortless nature is exactly what draws millions of wealth builders to the markets every single day.
Remember that $100,000 barrier to entry we just looked at for real estate? Yeah, with something like an S&P 500 index fund, you can radically lower that barrier. I mean, you can start investing with as little as $10.
It's completely democratized. Almost anyone, anywhere, can start building wealth in the stock market today for the price of like a fancy coffee and a pastry.
Now, what's really interesting about this slide is just how passive this wealth building actually is. You have absolute liquidity, meaning you can sell your shares and literally have cash sitting in your checking account in seconds. You get broad diversification, effortlessly spreading your risk across hundreds of the world's top companies. And historically speaking, the stock market has delivered returns of around 10% annually. And the best part? You get to earn those historical 10% returns without ever screening a bad tenant, without ever replacing a roof, and without ever fixing a broken pipe at 2 a.m. It is purely frictionless growth.
So, looking at the incredible leverage of real estate on one hand versus the frictionless liquidity of the stock market on the other, what's the ultimate strategy? Well, the truth is, the debate itself is a bit of a trap. Most self-made millionaires don't actually sit around agonizing over which side to pick. The real insider secret? They don't choose. They just use both. So the crucial point here is how you sequence these assets over your lifetime. This is the hybrid wealth building approach. Step 1, because of the super low barrier to entry, you build your initial capital base using the liquidity and high historical returns of the stock market. You just let compound interest do the heavy lifting early on. Then, step 2, as your net worth really starts to grow and that capital base expands, you then diversify that wealth into income-producing real estate. So basically, you use the stock market to build the wealth, and then you use real estate to protect it, leverage it, and generate steady, tangible income.
And just like that, day 12 of our FinFlow Media Wealth Challenge is in the books. But as always, the real work starts right now. I want to leave you with this question to chew on. How will you apply this hybrid strategy to your own portfolio today? Are you currently in that early capital building phase, just letting index funds do the heavy lifting? Or are you ready to step up and deploy some leverage in real estate? It's time to strategize and take action. To keep mastering asset allocation with us, make sure you hit that subscribe button, leave a quick like, and I will see you right back here tomorrow for day 13. Until then, keep building.